Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again talking about an awesome topic at the 360 headquarters.
That's it, Andrew. That's it. And a lot of value to our viewers and our listeners today. Not necessarily something that we've covered too much. I mean, I'm sure we've spoken about it because it is a general principle of investing or a general feature of investing. But we're actually going to do a deeper dive on investments, but specifically the difference in investment growth or wealth creation being capital growth or income.
Yeah, absolutely. I love it. I mean, and we get pretty excited when we haven't spoken about a topic. I mean, we're at, 100 and almost 20 episodes in. So when we've hit something that we've never spoken about before, which I think we've touched on a little bit, but we haven't done a topic before on it, we get pretty excited.
Definitely pretty excited. So look, we're going to go through probably some basics with it, but I think it's important to call it out. And then as we sort of work our way through the topic, then we'll get a little bit more specific and maybe use some examples around particular assets and what that looks like. But I mean, Andrew, from a really simplistic perspective, like, what are we looking at? What's the difference between each?
Yeah. I think the easiest way to explain it is to consider an asset that most people understand, and that's property, right? Capital growth is you buy a property and the value of that property increases. You buy a property for $500,000 and in 10 years' time, it's worth $1 million. You've had $500,000 worth of capital growth in the property. Income is the rental income that you also get from the property. So in that period of time, unless you purchase land, you've probably also gotten some rental income that's come into the property. Now, whether you're getting, $500 a week or $600 a week, whatever that is, you're also getting rental income at the same time as capital growth. And so those are the differences between a capital growth and an income in an asset. The same thing is also true for other asset classes as well. So you consider investing in, let's say, managed funds or ETFs. They've got the same element, a portion of growth, a portion of income. You invest in shares. You've got a portion of growth, and most companies, especially within Australia, will also pay an income to you as well. And so what we're really talking about today is, one, what are the differences between an asset that produces capital growth and an asset that produces a high level of income? What should I be focusing on? And what times, because as with absolutely everything, there's never a one size fits all and one asset class is better than another, or one type of wealth creation method is better than another. It's at one point in time does one become more attractive versus another, and how do you structure your own portfolios within that?
There's a lot to unpack with that. So I think you hit the nail on the head. It really depends on the investor profile. So we might use something like property because everybody seems to be familiar enough with it, but this could extend out to other asset classes. But if you consider, your objective of a property is probably the capital growth, right? So I think that's a fair enough statement that you buy a property in some point in the future, it's going to be worth more, and that's where you're going to extract your rate of return. So, fantastic. How do I get a property that maximizes my capital growth? And that could be a range of different things in terms of, a growth corridor, being that, land is going to appreciate in a particular area. So it's going to go up, population increases, infrastructure goes in and the like. It could be that you make improvements to a property and you're adding capital value. It could be something like a development where, you buy a block of land or you buy something, you knock it down, buy a block of land and away you go. So that is pretty straightforward, I think, from a capital growth perspective. But from an income point of view, I shouldn't say you'll need, this is an assumption, but income coming in to help support the investment over that period of time when you can allow the asset to grow, the capital growth to be able to grow. And in the instance of property, you've also got, with most property purchases, you've got an element of debt associated with it. So you need the income, in this instance, the rental income, to come in to be able to support the holding costs. So it's this balancing act in this example that I've used that, on one hand, you'd be chasing, in this particular instance, you'd be chasing capital growth, but you need the income coming in to help support it throughout that time frame.
Yeah. And here's, let's say, the perfect extreme on one side of it, right? You buy a property, you live in the property, you do capital renovations on the property, and then at some point in time in the future, you sell that property and roll that into the next one. And by letting time take its course, you've got hopefully capital growth in the value of the property by doing nothing. You're also doing improvements on the property. And so in addition to that, you've also got, some capital growth in the fact that you're putting money, effort, or blood, sweat and tears into improving the value of that property. And then you're living in it, so you're not actually receiving a rental income, but at the same time, you're not paying any capital gains tax when you sell the property because it's an owner-occupied property. But what all of that requires, so while that sounds like a really fantastic scenario, what all of that requires is income to be able to support not only doing the improvements that you would want to do on the property, but very likely there's a mortgage associated with it. There's a debt expense associated with it. And so unless you have that income or unless you have that security, then you don't have the ability to be able to enact a strategy like that.
Yeah. Yep. And once again, it really depends on your life stage as well too. So we talk about, capital growth in both of those examples, but let's say you're a retiree and you don't necessarily want to sell your assets in order to create or turn it into money in order to have income to live. So what you'll do potentially is you'll want income, whether it's in the form of a property with rental income or whether it's in the form of dividends and profit through shares or managed funds or ETFs. You'll want income to help you basically, live your life and survive.
Yeah.
So it really depends on what it is that you're aiming for. And it's different for everybody, which is why it's such a great topic. And there's so many different variables with types of investments in terms of what it is that you get. But I guess while we're talking about shares, Andrew, let's talk about franking credits because that's something in particular that we talk to people a lot about when we're talking about investing in particular with income. What does that look like?
Yeah, and that's one of the really big attractors from chasing an investment income while still having exposure to capital growth as well, is by investing in shares that have an element of franking credits associated with it. So what franking credits are, in its basic and most simple form, is when you invest in a company and that company has already paid 30% tax on all of their profits, which is the corporate tax rate. When you receive a dividend from that company, so when they're paying out their profits, the company has already paid 30% tax on all of their profits. And so you get a 30% offset on the dividends that you also receive so that you're not getting double taxed. And I think the easiest way to explain it conceptually, if you haven't heard of this concept before, is let's say Billy and I are in business together. We're a company and we pay a 30% tax rate. So if we make $100 profit, pay 30% tax, there's $70 that gets kicked out to the both of us. If we then pay our income tax on top of or on that $70, essentially the business is being taxed and then the individual is being taxed all on the same profit. Yep. And so what the franking credit system does is basically equalize that so that you're not getting double taxed. You put that into an environment like superannuation where in retirement phase you could be at a 0% tax rate or even at a 15% tax rate, and it can become very attractive. So when you start talking about receiving income into a portfolio and franking credits associated with that income as well, it can be a powerful motivator for people to be looking at income deriving assets rather than capital growth assets.
Yeah. And I think that's a good conduit into some of the things that we tend to see, especially with older Australians in particular. And we've all heard of the term asset rich but cash poor. So what this could mean in a really simplistic sense is that you've got, let's use property as an example. So you've got a lot of assets in terms of the property values, but your rental yield may not be large. So it could be that you've got, income coming in, but it's not a lot in comparison to the assets that you own. Or it could be, in a really simplistic sense, that you've got a family home that you raised your family with, you're still living there. It's a really big place on a big block of land. It's worth a couple of $1 million, but you don't have any income coming in from anywhere. You're asset rich, but you're cash poor.
And yeah, exactly. And I think property is probably the one asset class where this is most prevalent in.
Yep.
So I saw a client just the other day, and she's a retiree, has in excess of $5 million worth of assets. Now, of that, $2.5 million is tied up in a family home.
Yep.
But she's a retiree, has in excess of $5 million worth of assets, $2.5 million in a family home, and $2.5 million split across investment properties. And her income, in order to survive on, is approximately $65,000 a year, once you take out some of the expenses in managing the properties as well. You consider someone that's got $5 million worth of assets and is surviving off $65,000 a year in income. I mean, she's absolutely not cash flow poor, and I understand that for a lot of people that's a good level of income, but that's in comparison to the asset pool. Is really, part of that definition of asset rich but cash flow poor. And so how do you reposition assets because there was a need for a higher income level in order to suit retirement? If you need to spend $100,000 a year in your living expenses, well, you can't sell a driveway or a roof or a portion of the property in order to be able to, sustain the lifestyle that you want. And so how do you reposition your assets, or how do you not get in that position even better? The other consideration is, where are your assets sitting? So if you're sitting in property, asset rich, cash flow poor is a greater issue than if you're, let's say, sitting in shares.
Yeah.
So one strategy that some people choose to deploy is invest in capital growth assets, or invest in shares that may not necessarily provide a dividend and an income. But because you're invested in an asset class where you can shave off a portion of profit each and every single year, you've got the ability to, let's say, have, $500,000 in shares. You don't receive any dividends or income from it, but that $500,000 in shares has gone up to, $550,000 in shares. So you sell $50,000 worth of shares, live off the $50,000, and you've still got $500,000 worth of shares. So depending on what asset class you're in will also sort of change how you view this scenario and the strategy that you're deploying as well.
Yeah, no, look, very good point. One of the examples that I can think of with clients that I see all too often, I don't love it, where they are asset rich, cash poor, and it's usually around having properties, buying them back in the day for really cheap. They're worth a lot now. Maybe they've had a really long-term tenant. They've been good tenants. They haven't increased the rent, all of that sort of stuff. But they're basically living, with very small amounts of income, relatively speaking. But there's this trepidation around selling property in order to improve their lifestyle.
Yeah.
And I get it. It's really difficult to get into property. It's expensive. It takes a lot. It's a big sacrifice. I always feel conflicted when I have these conversations with people, because I'm like, okay, well, you bought that asset to grow your wealth, to hopefully give you, a better quality of life at some particular point in time. You clearly need that now. Convert it from the asset into something else where you can then turn it into cash flow and problem solved. But that's just a common example that I see all of the time, which I think is, the thinking's a little bit distorted in my mind. But look, each to their own, right?
And I think that's really an important thing to take into consideration when you are going through a wealth plan, particularly when talking to younger people. Mm-hmm. Not in the instance of, look, there is some financial benefit in diversifying your investments, but sometimes the financial benefit is not actually the key driver of benefit. It's if you've only ever invested in property and you reach, let's say in your scenario that you're talking about, your 60s, and you need to sell a property to convert it to another asset class that's going to derive an income, the likelihood that you're going to do that and the likelihood that you're going to feel comfortable doing that is extremely low. Whereas by starting earlier, investing in other asset classes and getting comfortable with other asset classes that you may not have otherwise been comfortable with can sometimes ease your way into that and can mean that you give yourself more options when the time comes to make a larger decision because you've gotten used to it and you know exactly how it all works.
Yep. Andrew, pivoting into, I guess, timing of income. I guess there's really a few trains of thought here with income in particular. You don't necessarily have as much flexibility from an income perspective because the asset may be deriving income at regular points in time. So as an example, if it is a property, you're receiving rental income on a monthly basis, or if it's a share portfolio, you're receiving dividends twice a year and they're set in terms of when that happens, versus something like being able to sell an asset and doing that at a particular point in time. Say it's in a financial year where your income is lower. So if you are paying capital gains tax, you time it and discharge that asset in a year where your income is lower. So your capital gains tax amount that you pay is less.
Yeah. So essentially what you're referring to is by having capital growth as opposed to income, you have more choice as to when you incur that capital growth and where you pay the tax on that capital gain, as opposed to in an income deriving asset, the income will come in on a regular basis. And so there isn't essentially a choice that you can make around, okay, it's at this point in time where my income is lowest that I want to actually receive that income and pay tax on it. So another point on the capital growth side.
Yeah, and look, on from a strategic perspective, I guess there's probably a couple of things. It's doing it in, like, timing it in years where there's going to be drops in income. So one of the things that I tend to think of is if you've got, people on, say, paternity leave and their income is less in that particular year, or being able to do that when people are in retirement phase where their income is naturally lower. From that perspective, especially if you're deriving your income from superannuation, you're not paying any tax, complete game changer. So there is some strategy behind when you discharge an asset as well too, because it can have a substantial difference on how much income tax you do end up paying.
Yeah. Look, another thing that does sort of help the capital growth side of the portfolio as well is, as you're talking about timing, it kind of makes me think about, okay, well, when you're deriving or when you're investing in an asset for the purposes of income, it can mean that you may take a shorter time horizon on the investment, whereas when all of your growth is, or when all of your profits you're relying on capital growth, it forces you to take a longer time frame of investment, because if you're going to buy an asset today and you're not going to sell it until you make a capital gain, you understand that it's going to take time in order to incur that significant capital gain. So you have to take a long-term time horizon, a long-term view. Rather than only looking at short-term fluctuations, because you might still have some income coming in from that asset, so it's not as detrimental to ultimately sell it.
Yep. Let's think about it from, say, a business owner's perspective, maybe like a small business owner. You've made particular profit. Like us, we can distribute profit at, like any business owner, I guess, at any particular point in the year when you see fit. So do you do that and that's in the form of income, or do you take that, reinvest that back in the business to then make the capital of the business or the value of the business worth more?
Yeah.
So that's a good example, using that with, I guess,
capital growth versus income, right? And I think that's relevant, because when you consider investing, most of the time people think about, you give money to someone else and they invest it on your behalf. But if you're self-employed, you're making that decision really on almost a day-to-day basis. It's, we've made the income, we've made the profit. Do we redistribute it out? Do we take that profit, convert it into personal wealth? Or do we reinvest it back into the business and try and make either the asset pool larger or the future income even larger. So yeah, definitely is a very sort of valid consideration when you're considering things on a business owner side of things.
Yeah. Yep. On the capital gains perspective that we've been talking about, and if that's your strategy where you're growing the capital, it kind of forces a longer term time frame anyway, right? Because you need time for that asset. And especially if we talk about, going back to our first example where we're thinking say property, just because that seems to be, something that a lot of people can resonate with. If you think about the time frame for that, it's less liquid. It costs money to sell it. You need to market it. You need to prep it. You need to do all of that sort of stuff. But in terms of getting into the property, you're paying things like stamp duty, right? So your costs that you've incurred, at least at the start, and maybe you've incurred mortgage insurance and but what have you, at least at the start, you are incurring costs where you need a longer term time frame in order to recoup those costs.
Yeah, and exactly as what we sort of spoke about in the first scenario is you need to consider your holding costs as well. I mean, if that property is not, even if it is, but if that property is not tenanted and you've got something like land and your plan is to, develop that property and do something with it, you need to be able to cover all of the costs until the point in time that either you sell it or until the point in time that you start deriving an income from that asset. If you're relying on, let's say, a sale in order to be able to cover in order to be able to pull the profits out of that asset, you're also reliant on the sale of a particular asset on a particular day and in a particular market. So your risk, you have a much larger timing risk when you're relying on capital growth, because whether it's invested in a stock, whether it's invested in a managed fund, whether it's invested in a property, whatever it is, the particular day in which you sell it may mean that, we've entered into a recession and that you can't get what you expected for it, or it may not be the most opportune time to sell that asset and it may increase further in the future. So there's an opportunity cost side of things, but the risk is on you're capitalizing your asset on one particular day, as opposed to when you're receiving income, you're getting that capitalization each and every single month or quarter or whenever you're receiving that income as well, which can remove an element of risk associated as well.
Yeah, and I think that's what we're seeing recently with the investment property market in particular, simply because interest rates have gone up so high and the cost associated with holding a property has become more expensive because the interest rates have gone up. So if investors in that position either don't have the cash flow to cover it or don't have the appetite to cover it, then what do? They sell. Once again, is now the right timing in the market cycle? Is now the right timing in terms of timing their discharging of that asset, capital gains tax, and what does that look like down the track? So that's a really perfect example of, it doesn't take much to derail that. So you do need some really key planning in place, because the market can change and dictate what it is that you do without you even, considering that in the first place. And we've seen that quite rapidly with interest rates going from, practically zero to now where they are, 16 months later. We've seen the fastest rate of increases that we've ever seen in history. So from that perspective, that's a really perfect live case example of what that looks like.
Yeah, and let's consider you're, potentially retiring today, or your expected retirement time frame is today, and your asset isn't at the value in which you expected it to be today. Well, what implications does it have? I mean, either you're reducing your expectations or you're making other adjustments, or alternatively, you're saying, okay, well, I'm going to have to work for another year, 2 years, 3 years until the value of it eventually gets to where I originally had expected it to be. And so it can mean that one seemingly small thing, because when you're looking at volatility over time, it's quite small in nature, can have a very detrimental or very significant impact to the overall strategy. The other thing that I is a very interesting point in all of this, and particularly when you're talking about property, is how capital growth can help facilitate snowballing your acquisition of assets. And let's take examples of, okay, you have a high income producing asset to snowball into your next property purchase, or you have a high capital growth producing asset to snowball into your investment purchase. You buy an asset and rely on income from it. Well, you need the income to flow through. The income needs to be more than your expenses. You're then going to pay tax on the difference between your income and expenses. You then need to put that money into a savings or an offset account and accumulate that and have the structure to grow that over time. And then you take that and put that as a deposit on a property.
Yep.
Versus you buy a or an asset that you expect to increase in capital growth, and you allow the capital growth to just happen. And whether that property is positively, negatively, or neutrally geared is fine, provided that you've got the cash flow to manage it. But at a point in time where the growth has risen on the asset and the debt level has either stayed the same or declined, you just take the equity out, don't pay any tax on the equity, and use that to purchase another property. So capital growth, assuming that you can service the additional mortgage and assuming that you've got the income behind it to back it up, can really help facilitate snowballing of properties into the next one as well.
And let's be realistic. I mean, that's how we've seen people grow substantial property portfolios. It's not necessarily that, and I'm making a big generalization here, but it's not necessarily that people are, you purchase a property and then you've gone and saved up another $250,000 to go again, which is your deposit plus your stamp duty, and then so on and so forth. It's using I feel like the old CBA ad with the equity mate, right? So being able to take out equity mate out of the property and using that as your deposit and closing costs for the next one, and away you go. So you find that assuming that your properties continue to increase in value, the more and more properties that you accumulate, the more capital growth that is, the more absolute capital growth that's being built, the faster and faster, which is that snowball effect that you're talking about, but the faster and faster that can happen. And that's what we've seen. That's what we've seen with a lot of people that have built up property portfolios and how they've managed to achieve that.
Yeah, but again, same token, you do that over time and eventually you've got a whole bunch of money seeing an asset class that isn't producing a whole lot of income. And so then what happens? What's your exit strategy? What are your alternative assets? Which really kind of rounds things out in that in order to, have a well-balanced strategy, you need to have elements of both. If you don't have income coming in, then even purchasing, the next property or the next asset from a bank lending and serviceability side of things becomes difficult. And so having a well-balanced strategy is probably the most important thing in all of this. And everyone's balance is different. Mm-hmm. It doesn't mean that, there's a one size fits all and there's a, optimum point for absolutely everyone. Whether you sit at, 30-70 on the portfolio or whether you sit at 50-50 is going to depend on your situation, your strategy, your goals and your outcomes. But having a well-rounded approach is ultimately going to yield the best chance of, having a solid result at the end of it. Yeah.
Get advice.
Exactly right.
Andrew, hopefully that was a good summary of capital growth and income when we're thinking about assets for our viewers and our listeners. Hope you got a whole heap of information out of that. Like always, if you want any more information, feel free to reach out to Andrew and I at the team at 360 Financial. Andrew, thank you for today.
Thanks for another great podcast, Bills. That was definitely a cracker, and look forward to catching you all on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.